Hi everyone. So today we're going to have a look at farm, business and technology. Um, the farm, business and technology module is made up of 2 exams, which are 15 short questions each and 2 structured questions. And then there's also some practical skills to the module as well. So today we're going to focus on the first exam, which involves chapters 1 to 3. Okay, so Farm, Business and Technology, Chapter 1. We're going to have a look at the agri business sector in Ireland. We're going to analyse the sector, including a range of enterprises, the role of the government and non-government agencies, and also some co-op agencies. So farmers deal with lots of different businesses in the sector on a daily basis. So here is some examples of different types of businesses within the agri sector. So we have there grain purchasing, animal feeds manufacturer, financial institutions such as banks and lending agencies that provide finance for farms, and they also monitor the transfer of monies. We have farm advisory, which give us help and advice with regards to our farming enterprises. We have farm input sales, so that's the likes of feed and fertiliser, farm facilities, machinery and equipment. We have farm sales then, milk processing, so almost all milk produced in Ireland is processed through co-ops. And then we have meat processing, so the purchase of animals for slaughter, processing and marketing. So they're just an idea of some of the businesses within the sector. So dealing with businesses, it pays to shop around for the best price, as we all know, before you secure any deals. Be confident to negotiate competitive deals when purchasing goods, and look for credit and be aware of its cost. So we all know credit is the ability to obtain a good and pay for it at a later date. So shop around for the best credit, because majority of the time interest comes along with credit. So you'll pay for what you've purchased, but there also will be an added price of interest there as well. So shop around for the best interest rates before you secure any deals, and be confident to negotiate. So the size of the current agri sector, so there's a vast range of businesses involved. There's a number of factors which indicate the importance of the agri business sector to the economy. So number one there is agricultural exports. So in 2019, over 14.5 billion euros worth of exports were generated. Contribution to GDP, so that's the gross domestic product, and then contribution to employment. So currently there's over 167,500 people employed within the agri sector. Self-sufficiency in agricultural produce. So what it means to be self-sufficient is that you do not have to import any goods. You have enough to provide for your home market. Okay, so you have enough of this produce for your home market and you don't need to import anything. So for example here, with regards to beef and veal, Ireland are 698% self-sufficient. Pig meat, we are 207% self-sufficient. Sheep meat, 330%. Poultry meat, 85%. Butter, 1082, so we've more than enough butter than we need. Same with cheese, drinking milk and cereals. So basically that just means we have enough for the home market and you don't need to import. Agricultural exports then. So Irish exports of agricultural products account for 9.5% of total merchandising exports and 12.2% of imports in 2019. So a lot of these figures are dating back to 2019 because the 2020 figures aren't yet released. When it comes to time for you to be viewing this PowerPoint, the 2020 figures and statistics should be released, so just take a quick look at them and you'll identify whether our exports have gone up or down in the past year. The value of the agri-food exports for 2019 totaled at 14.5 billion, up 6% on 2018 figures and up 63% on 2010 values. Approximately 2/3 of exports go to high-value markets in the UK and the EU, with the balance going to the rest of the world. So obviously, Brexit is going to have a huge impact on Irish agricultural exports, as a vast majority of our export market goes to the UK. So then we're moving on to types of businesses and business arrangements. So one example of a type of business arrangement you may have is you may be a sole trader. So this is what majority of the time farmers are, they're sole traders. So this is an individual that owns and runs a business independently. So examples are farmers, butchers, doctors, jewelers, hairdressers, and painters. This individual provides the money for setting up the business, so it's coming out of their own pocket. All the profits are kept by this person and any losses are borne to this person. So if the business is in loss, that means you yourself, as a sole trader, you are subject to losses as well. It's the easiest type of business to set up, and the majority of businesses in Ireland are operated as a sole trader. So again, examples include farmers, butchers, doctors, jewelers, hairdressers, painters, and there's also many more as well. Another type of business arrangement is a partnership. So this occurs where at least two persons conduct a business in common with the view of making a profit. So these two people, the one goal that they have is to work together in order to make a profit. Net profits are shared between the partners according to the written partnership agreement. So obviously any partnership agreement should be wrote up by a solicitor outlining the role of each member in the partnership and what proportion of the business they own or what proportion of the profits they are going to gain from the business. Each partner's share of the net profits of the business is treated as his or her own personal income, and they pay their personal tax on this share. So again, shares will be different within a partnership, but you will pay tax on your share. Once tax is paid, the partners have full control of their share of the profits. So after you've paid your tax, you can do whatever you want with your own profits, regardless of the other person within the partnership. Okay, so working in partnership allows farmers to get involved to harness the benefits of collaborating with other farmers. So have a think to yourself, what do you think would be the benefit of being in a partnership? So I have a few here. So more labour availability, okay? So the task on the farm and all the labour isn't completely left up to one person. It's shared equally or proportionally. Wider variety of skills available. So people are good at different things. You might be very good with livestock, whereas the other person in the partnership might be very good with machinery. So it brings a vast range of skills together and interests together. Opportunity for increased sale. So to take on more and to expand, because there's more labour available, there's more finance available, along with many other things. So there's more opportunity to expand and increase the scale of the farm. Better decision making. So this will come down to you have someone to talk your ideas through with, or any major farm decisions that have to be made, and you also have support there behind the decision making, support and reassurance. Cut out duplication of routine tasks. Okay, so you're not going around doing the same thing all day. Tasks are shared equally. And a better work-life balance because you're sharing the workload effectively. So in all cases, a written partnership agreement must be drawn up by a solicitor before the business trading begins, okay? So it's so vital that you do seek professional help and assistance before you go into a partnership. So this will be seeking the help of a solicitor, an advisor, or an accountant, okay? So Don't rush into things, always seek professional help. So these are the key things that you must keep in mind and that contribute to a successful partnership will be the likes of mutual respect, transparency, good communication is vital, and again, honesty is vital there as well. So before you go into a partnership, I said it's so important you do seek professional help, know exactly what it means for you and what you're getting yourself into, and also what does it mean for you down the line. So a lot of young farmers will be getting into partnerships with whoever's farming at home, but definitely look into what it means for you down the line in years to come and how it's going to affect your farming career, either positively or negatively. Okay. So then we have limited companies. So a limited company is known as a legal person and is a separate legal entity to the people that own or run the company. Okay, so the entity has its own legal rights and obligations and is separate to those running the company. Shares in the company are created when it is formed and owned by its shareholders. So there's going to be shareholders in the company. There's 4 types of companies or limited companies. So we have a private limited company by shares, a company limited by guarantee not having a share in capital, a company limited by guarantee having a share capital, and then a public limited company. So most farmers that change over to companies operate as a private limited company, and that's when you'll see the likes of the LTD letters after the farm name. So a private limited company must have the word limited or LTD at the end of its name. So key points on a private limited company: it can be owned by any number up from 1 to 99, so it can have up on 99 shareholders. The company pays tax at a corporate rate of tax. Profits of the business become the company profits and do not personally belong to any individual. So that's completely different to a sole trader. The shareholders or employees are paid a salary and must pay personal tax on the amount of salary withdrawn from the company on an annual basis. Okay. Examples of private limited companies within the agri sector are the likes of O'Donovan Engineering, Building Fertilizers, Chanel Animal Health, and Abbey Machinery. So they're just a few examples to give you an idea. Advantages of a private limited company then: income tax is paid at a corporate rate. The owners are not personally responsible for any debts of the company except where they give personal guarantees. Surplus cash or money after tax may be retained in the company as a fund for farm expenses in years of difficult farming. So as we all know, every farming year is different. Profits might be a lot higher in one year compared to another. So that's where this surplus money is left for years of difficult farming or of reduced income. A company may have an advantage over a sole trader when purchasing land. Losses can be carried forward and offset against profits in good years. That's what we previously spoke about. And ownership is transferable, but careful tax advice is required. So you must seek advice when doing this. Disadvantages of a private limited company then. So a more complicated set of accounts must be kept for the business. Annual returns and accounts must be filed with the company's registration office, and costs can be significant in doing so. A company is more expensive to set up. Access to business profits may be difficult. There may be difficulties with herd numbers and basic payment entitlements. Careful advice and planning is required in relation to capital taxes and stamp duty. But I think this applies to all types of businesses. Careful advice and planning is always required. More closely regulated by the law compared to a sole trader or a partnership. Existing capital allowances cannot be moved into the company, and the company must own property to claim capital allowances on any investment. So public limited companies have the letters PLC after their name. So This is different to private limited companies. This form of company may trade its shares publicly, but results in some of the larger companies having their shares listed on the stock exchange. In return, the company, its owners and management must disclose publicly a great deal of information with the company's registration offices for public inspection. So then we have a cooperative. So a co-op or cooperative is legally incorporated business, which is owned and controlled by the people who work within the cooperative. Work on the basis of one member, one vote policy. This brings fairness in the running of these co-ops, regardless the size or number of shares. Everyone still has one vote and each vote has the same value. There are many different types of co-ops in Ireland and throughout the world. So perhaps in one of your exams, you may get asked to name 3 or 4 co-ops. Make sure it is these examples here you name and not co-ops throughout the country. So examples of co-ops are primary producer co-ops, consumer co-ops, credit co-ops, housing co-ops, and worker co-ops. So these are the examples here. Then some of the co-op names we know throughout the country are North Cork Creameries, Dairy Gold, Credit Union, and Lakeland. Okay, so they're just some examples. If you were to list these names in your exam, that would be incorrect. You must name the types of co-ops. Then we have some government and non-government organisations. So there's a number of government and other organisations that farmers deal with on a daily basis. So the primary one there is the Department of Agriculture, Food and Marine, otherwise known as DAFM. So their function is to provide policy advice to the government, representation of Ireland in international negotiations, implementation of schemes, regulation of agriculture, fisheries, forestry, and the food industry. Then we have the Department of Communications, Climate Action and the Environment. So their role, they have responsibility for communications to energy, to climate and to the environment. We have the Department of Transport, Tourism and Sport. This department has oversight for roads, driver testing, traffic issues, bus and rail transport, aviation and road safety. Then we have the Department of Rural and Community Development. So these are responsible for policy and support in respect to community and rural development. Then another one you're very familiar with will be Teagasc. They were established in 1988. The mission of Teagasc is to support science-based innovation in the agri-food sector and the wider bioeconomy to underpin profitability, competitiveness and sustainability. So these are conducting science-based research and innovation to provide us with the best information to increase profitability, competitiveness and sustainability on our farms. This method gives Teagasc responsibility for meeting the knowledge and technology needs of the agri-food sector. So research is continuously ongoing and they're providing us with the best research proven advice that's out there. Then Board Bia is another one you're probably familiar with. It was established in 1994. The role is to act as a link between the Irish food and drink suppliers and existing potential customers. Board Bia is deeply involved with Irish farmers and meat processors and works to promote Irish produce across the world through its quality assurance schemes. So Board Bia places huge emphasis on the quality standards on farms, traceability and record keeping. Farmers contribute towards the running of Board Bia by paying a compulsory levy on all animals slaughtered in Irish meat plants and all animals exported live from Irish ports. So in order, or as a bonus for being and cooperating with Board Bia, farmers receive a bonus price when they slaughter their animals. So this price varies depending on the time of the year, but on average it's around 20 cents per kilo for beef and it is around 10 cents for lamb. and also dairy farmers get a Board BIA bonus there as well. So when you see this symbol on produce, that means it's Board BIA quality approved. That huge emphasis has been placed on quality, traceability and record keeping on farms. And that also makes Ireland more attractive for the likes of our export markets when we can provide this assurance that the food is of high quality and of high standards. Then we have Ard Nua there. So this is an agri-food commercial co-op with markets and sells dairy products on behalf of its members. It exports to over 110 countries worldwide and has sales of 1.7 billion annually. And that's the Ard Nua symbol there. Irish government agencies then. So we have Environmental Protection Agency. So this is an independent public body established under the Environmental Protection Act. It coordinates the monitoring and protection of Ireland's environment. So the likes of waterways, ecosystems, biodiversity, and greenhouse gases. The EPA's function includes liaising, environmental law enforcement, environmental planning, monitoring and reporting, environmental strategy and waste management. And then we have some other government agencies. We have Quilcha, so they're related to our bogs. We have Horse Race in Ireland, Horse Sport Ireland, Board Iscimara, that's to do with fisheries, Fudge Ireland, the HSA, that's the Health Safety Authority, Food Safety Authority Ireland and Organic Farmers Association. So the most important government agencies we have there is Department of Agriculture, Board BIA, Ard Nua, and what else have we previously measured? The Environmental Protection Agency. And there's just some extras. So you may be asked to give an example of a government organisation. Then we have some farming organisations. So we have the IFA, which is the Irish Farmers Association. We have the ICSA, so that's the Irish Cattle and Sheep Association. We have the ICMSA, the Irish Creamery Milk Suppliers Association, Macra na Farma. And the aim of these farmer organisations is to represent the interests of farmers in all sectors of agriculture and be a voice for farmers. Then we have chapter 2 is farm financial and physical records. So here we're going to have a look at and examine the range of documents and information needed for complying physical financial records for your farm. So why is it important to keep both physical and financial records? So accurate records and accounts help farmers maximise profit from their farming enterprise. So you analyse inputs and outputs to identify areas that need improvement. So it's important when completing grant application forms, making income tax returns, applying for bank loans, and again, identifying areas that need to be addressed. So for example, when you have a look at your records, both physical and financial, you may identify an area of the farm that needs improvement or needs to be addressed. So for example, you could see that you're spending a lot of money on feed and fertilizer, your vet bill is very high, and so on. And then you can address these areas to increase the profitability and the productivity on your farm. So accounts are a permanent record of all financial transactions in the operation of the business. So what are accounts? Accounts are a permanent record of all financial transactions in the operation of the business. Every business, no matter what size, must produce a set of accounts at the end of the year. Farm accounts are records of financial transactions which take place during one production year, starting at the 1st of January and ending at the 31st of December. So why does a farm need to keep a set of farm accounts? So firstly, they're nearly the most important one is to measure profit and loss. So farmers need to know the extent of the profit or loss of their farming enterprise. Without accounts, it's impossible to accurately determine whether you're making a profit on your farm or whether you're at a loss. Second reason there, for taxation purposes. So farmers in the self-assessment category are legally obliged to calculate their tax liability and pay and file their tax return to the Revenue Commissioners by the 31st of October each year. So the type of taxes that farmers are liable for are PRSI, that's your pay-related social insurance. USC is your universal social cards. Capital gains tax, capital acquisitions tax, and then value added tax or VAT. Reason 3 there is for grant aid and VAT returns. So farmers seeking grant aid for development work or refund for VAT must provide one or all of the following: your PPS number, your tax clearance certificate, and a completed set of accounts. The fourth reason there is to avail of third level maintenance grants. So if you have a child going to third level, you will be means tested. So that therefore you do need a set of accounts. Reason 5 for a successful loan application. So the primary concern of a bank manager when considering you for a loan is, do you have the ability to repay the loan that you're applying for? The chances of a farmer securing a loan are greatly reduced where their repayment ability cannot be clearly demonstrated and supported with evidence such as accounts. So they want to see all your transactions. They want to analyse your farming enterprise and see whether or not you're at a profit or a loss before they give you your loan. Reason 6 there is for examining the farm business. So farming is a business made up of many different components. Without detailed information about the KPIs or the key performance indicators, the performance of the farm is difficult to analyse. And this particularly comes into if farms that have a number of different enterprises on the farm and you want to analyse how each enterprise is performing. So you will have a set of accounts broken up for your beef, your sheep, your dairy, your tillage, whatever it might be. So you can analyse each individual enterprise. Accounts must be prepared in a format that allows you to see at a glance the contribution of each enterprise to the profit and loss of the farm, how physical and financial performance compares to Teagasc standards. So Teagasc have average profit monitor figures published, and you can compare your farm to other farms of similar enterprises and sizes, and you can compare the profit that they're making per hectare or per animal versus what you're making. The variable cost of each enterprise and the fixed cost of each enterprise. And then reason 7 is the physical efficiencies. So it's important that farmers record physical performance on the farm. You can't manage what you don't measure. Okay, so physical performance, or the KPIs as we would say, are broken up in the following table. So the things that will make you a profit on a dairy farm will be the likes of the quantity of milk you're yielding, the milk price that you are receiving, the amount of milk solids you're producing, your calving records, your breeding information. So how long in the breeding season are you breeding for, what animals are you using, grassland and nutrient management, and your veterinary records. Then on a beef farm, we look at what slaughter weights we are achieving, what price are we receiving, what price are we purchasing these beef animals at, calving records if you're a suckler farmer, so how long are you calving for, how long is your calving period, what's your mortality rate, what's the average age that heifers are calving down at. Then we have breeding info again, your grassland and nutrient management, so tons of grass grown, slurry, when are you getting your slurry out and your fertiliser. And then we have veterinary records. For tillage, you have crop yields, sale price, varieties of crops you're selling or growing, crop rotation, what's your soil test results, so that will also come into play on your dairy, your beef and your sheep farm, the nutrient management on your farm, cultivation and seed records. For slaughter weights, then we have, for sheep, then we have slaughter weights, the prices that you're receiving, mating records, so how long is the ram out with the ewes for, and how many ewes are in lamb in that certain period of time. Lambing records, weights you're achieving, grassland and nutrient management, and then also your veterinary records there as well. So reason 8 then is to monitor and control spending. So unless there is a system for monitoring and controlling, farm spending may go out of line with farm income and may be unable to meet costs. So you may go into severe overdraft if that's something that you have on your farm, or else you may generate a large amount of debt for the farm. Reason 9 then is to enable your advisor to draw up a detailed farm development plan. So before any major farm investment is taken out, whether it be on land or buildings, it's critical that the farmer and advisor know the current farm income, the physical and financial performance, and also the effect of the proposed changes on the farm income. So a lot of you will be familiar with this, the types of farm bank accounts that are out there. A farmer will have a number of different accounts depending on their purpose. So our current account, everyone has a current account. We have a deposit account, seasonal loan account, term loan account, and a hire purchase account. Bank statements and bank reconciliation. So bank statements are available online or issued to customers on a regular basis. They are a record of all transactions that have been implemented by the bank on behalf of the customer. So we then have lodgements, withdrawals, account transfers, direct debits, standing orders, bank charges, ATM transactions, and interest charged. So this is all recorded on your bank statement. So when a farmer receives a statement, the entries of that bank statement must be cross-checked against the records kept by the farmer. So see, are your bank statements matching up to the records that you have kept? At the end of the accounting year, the farmer should also check lodgements made but not yet credited to the account, checks written to you but not yet lodged by the payee. So end of year reconciliation. At the end of the year, you must reconcile the bank balance with the farm balance. This involves adjusting for unpresented checks and lodgements that have not yet been credited. So it ensures there is no differences and that they match up. Then we have financial performance. So companies like IFAC provide an account management service for farmers specifically. Teagasc eProfit Monitor and other software packages also give added management information. So as part of the course, you will be getting familiar with eProfit monitors and analysing the information that you receive from doing an eProfit monitor. Nowadays, farmers use accountants to finance their tax affairs. So key differences between management and taxation accounts. So management accounts. Assets are usually at the market value. As much enterprise information as possible, such as yields, stocking breaks, enterprise breakdown on the sales and costs, etc., for the farmer's use. Then we have taxation accounts. There are separate tax rules for valuing assets. Very little enterprise information is needed and completed for revenue commissioners to read. So your eProfit monitor is your management account, and then your taxation accounts are usually done by accountants. Opening and closing inventories. So part of measuring performance is being able to value assets and liabilities. Crops, animals, and other stock are usually on the farm at the end of the year. So why does this matter? It matters because what happens in each year needs to be separated, or else you may get confused on what happened and why it happened. An important part of this module is to be able to take stock value and see what it is now and what it was at any other given time, and this is called inventory. Okay. So then when we're looking at the land we own or rent, total hectares can be found by looking up your Ordnance Survey map, or in recent weeks you would have received a basic payment application and the amount of land owned is on that as well. So a lot of you would be familiar with acres in comparison to hectares. So if you want to convert your acres to hectares, you multiply by 0.405, or you can divide by 2.471. If you want to convert your hectares to acres, you multiply by 2.471. So there's an example there. 48 acres multiplied by 0.405 will give you nearly 19.5 hectares. Again, you could do that one by dividing by by dividing by 2.471. And then if you want to convert hectares to acres, it's 19.44 multiplied by 2.471. That'll give you 48 acres. So land rented, this means that the total area of land that you have rented from another farmer. It includes the land taken on a short-term basis, that's otherwise known as conacre, or also land that you've taken on a long-term basis, so more of a lease than a conacre. We're going to look at depreciation of assets. So depreciation represents the fall in value of some items over time due to wear and tear. So examples of non-depreciable assets that don't lose their value, will be the likes of land. And then depreciable assets are items that lose value due to wear and tear, so such as machinery and buildings. So how fast an asset loses its value depends on the amount of work it does per year, how hard or difficult the work is that it's carrying out, and how hard the operator is on the machinery. So the rate that applies when writing off the cost of purchased assets is based on the period that is considered to be their useful life. So when preparing accounts, the accountant uses this depreciation figure in a profit and loss account. So buildings can be anything from 0 to 10% per year. Plant and machinery is 5 to 10% per year, and then motor vehicles can be anything from 10 to 25% per year. So when preparing a set of accounts, the accountant and the farmer will decide on the appropriate level of depreciation. This value is used when calculating the profit. This allows the accountant to write off the cost of the asset each year as it falls in value. So then we have, how does an accountant calculate depreciation? So depreciation must reflect the true wear and tear on machinery or buildings. Diminishing balance method, so a tractor worth 60,000 depreciated at 10% per year, which is 6,000, is worth 54,000 at the end of its first year. The accountant then gets 10% of the 54,000 in the second year, and so on. So that's the diminishing balance method. Then we have the straight line method. So this involves taking the same amount of depreciation away each year. So the tractor is worth 60,000 and the depreciation is 10% of the original cost. The tractor will be worth 54,000 at the end of year 1 and 48,000 at the end of year 2, and this will go on as well. Tips for calculating depreciation and valuation of assets. So depreciation should not be confused with tax reliefs called capital allowances. So capital allowances are reliefs which can be claimed when you build a building or buy a machine. Depreciation must always be worked out on the net cost of the asset. This means you must always conduct any grants received or VAT refunds claimed on the asset. So the net cost is the gross cost minus any grants received or VAT returns. For example here, if you paid 9,000 for a hedge cutter, you receive a grant of 1,000 and a VAT refund of €750. Therefore, the net cost of the hedge cutter is 7,250 because you're taking into account the 9,000 minus the grant you received and the VAT. So this is the figure that you use to work out your depreciation then. And then we have chapter 3. We're just going to go through some of the farm business terminology and technology that's out there. So general farm business terms, you may be familiar with some of these more so than others. So the turnover of your farm enterprise, or business, is the value of the total sales given over a certain period, which is usually a year, minus any discounts or sales taxes paid. Your cash flow then, this is the amount of money being transferred into and out of the business over a given period. It can be measured by simply finding out the difference in the amount of money available at the beginning of a period, called the opening balance, and the amount of money available at the end of the period, which is called the closing balance. Bank accounts are a good source of cash flow information. So again, your cash flow is any money in, so any receipts minus any money out, which are payments. Profit then is a measure of how well a farming business is being run in a production year. So buy low to sell high is a motto that many people will go by. The first concern of anybody operating a business is to know the extent of the profit or loss. So this is why it's so important that you do keep a set of farm accounts. There is a difference between profit and cash balance. So the profit calculation contains some non-cash adjustments, such as accounting for difference in the opening and closing values of livestock. The cash balance in the bank balance is the bank balance plus cash in hand. Then we have debt and repayment capacity. So debt is money owed either by you personally or by the farm business. For example, a credit card account issued by your bank allows you to purchase goods or services on credit, which must be paid some weeks later. So again, remember, credit is when you receive the product or the produce, you pay at a later date with an added interest cost. For large investments such as purchases of land, machinery, farmers usually apply to their banks for long-term debt or long-term loans. The primary concern of a bank manager when considering a loan application is the ability of the farmer to repay this loan. So again, they're going to look at a full set of accounts, profit or loss sheets, and they want to know everything. Unless repayment ability can be demonstrated clearly and evidence provided in the form of a set of accounts, the chances of obtaining a loan will be reduced significantly. Fixed costs then, so these are costs which are incurred by most businesses irrespective and do not vary with small changes in size or intensity of the enterprise. Okay, so we have both fixed and variable costs. Your fixed costs can't be allocated to one single enterprise on the farm. So examples of fixed costs would be the cost of leasing land, machinery repairs, electricity bills, and accountants. So these are costs that cannot be allocated to one single enterprise, and they're sometimes referred to as overhead costs. Then we have variable costs there. So these are costs that can vary with changes in size or intensity of the enterprise. So they're directly linked with one enterprise, and variable costs are sometimes known as direct costs. So examples we have there is AI, fertilizer bills, feed bills, and veterinary costs. So it's important that you know the difference between a fixed cost and a variable cost. We have gross output and gross margin then. So gross output is the value of the products produced in that enterprise. So for example, it could be beef, lamb, milk, and so on. Gross output of a farm enterprise should also take into account net changes in stock. So these are the inventories. such as changes in the value of cattle between the beginning and end of an accounting period. So the gross output on your farm is the sales plus your closing stocks minus livestock purchases plus your opening stocks. Gross margin of a farm is the gross output minus variable costs. Gross margin figures are useful for comparing the production and economic efficiencies, comparing farms with similar characteristics such as land, enterprise mix, and production systems. Net profit then, you might be familiar with this. So your net profit takes into account all of the overhead costs associated with running a business. So if you work out your gross margin, you can discover your net profit by subtracting all the overhead costs. So your net profit, in other words, is your gross output minus all your costs. So these are both fixed and variable. And that, again, is the money that you have in your pocket at the end of the day. And that's it. So if anybody has any questions on that, feel free to email in or ring in and we can go through it maybe in a bit more detail if you'd like.